Hello everyone and welcome to week 7 for the massive open online course of the University of Nicosia's master's degree in digital currencies. I'm your teacher Andreas Antonopoulos and I'll be answering all of your questions from the last week and for the final material for me. Next up is one of your other teachers, and I will see you again in the next semester's running of the Massive Open Online course. So this is it for me. I'm going to try and cover as many of your questions as possible today, and we have some great questions. Hello everyone on the chat, good to see you again. I see quite a few of my students, Equinuka, Elena, Gregory, welcome. Thank you for all of your great questions. All right, our first one comes from Subra. Subra asks about cryptocurrencies, the industry, and future outlook. With over 7,400 cryptocurrencies listed and fulfilling various needs of business, how do you see the industry evolving in future? Do you see a further increase in the number of cryptocurrencies? Do you see consolidation and future taxonomy that will base on the usage of such coins, or will it be like fiat currency, where each country will have their own currency regulated by a centralized government body? Well, this is really interesting because I think one of the things that has changed is our conception of what a currency is, who runs it, and how many there could possibly be. You see, in the past, with the fiat currency world, there were 194 currencies belonging to 194 governments, more or less, and each country had its flag currency. Now, this is very similar to how airlines were run in the 1970s. There was very clear distinction. Air France operated in France, British Airways operated in Britain, etc., etc. And most countries had one airline, and that airline was the national carrier. One airline, one phone company, etc., etc. Nowadays, you may not even know where the airline that you're riding on is operating from. It doesn't belong to a country. These are all multinational corporations. But I think another way to look at it a bit is like the early days of the web. So maybe in 1995, you were looking at the early internet, the first websites that were popping up, and you were looking at it and going, wow, there are now hundreds of websites. New York City has its own website, and Boston just created its own website. What does the future hold? Will every city have its own website, and will they be run? Will a country have its own website? How many websites could they possibly be? And the answer is as many as people on this planet, and possibly more. Billions. The same thing is happening to currencies. There is no limitation to how many currencies anyone can create. The process of creating a new currency, monetary system, token that represents something of value or something without value, this process is now available to everyone. This is a form of expression. So the question, how many cryptocurrencies will exist, is exactly the same as the question, how many bloggers will exist, how many webcasts will exist, how many YouTube videos will exist, how many websites will exist. And the answer is an uncountable number that will change every second as people start and stop building cryptocurrencies, and we won't know about most of them. When we say there are 7,400 cryptocurrencies listed, that's because there is a website that is trying desperately, in fact there are several websites that are trying desperately to list all of the cryptocurrencies, which ironically is exactly how in the very early days there were websites that were trying to index all other websites. Yahoo, in fact, started that way. It was a website directory. Meaning that you had categories of websites and then it listed all of the websites that were under a specific category. Now, this seems ridiculous now because you immediately realize there's absolutely no possible way you could list all websites in a category, and such a directory would be impossible to manage. So instead we switch to a model of search. Now imagine what happens when cryptocurrencies become too numerous to list. At that point, finding out if a cryptocurrency exists really is more of a matter of finding out how to search for cryptocurrencies, and many of them will be obscure and irrelevant, and some of them will be very, very big, powerful, and popular. Like many other areas of information science, what we will see is the emergence of what is called a power law or Pareto distribution. That is the 80-20 rule, as you may have heard it, where 20% of, let's say, the websites in the world have 80% of all of web traffic, but then there is a long tail distribution of millions and millions, perhaps billions of tiny websites that only have 1 or 2 visitors, and that long tail never ends. And it keeps getting longer. Cryptocurrencies will operate like that. There may be a handful of cryptocurrencies that have 80% of the market capitalization, users, developers, and all of the other important metrics. And then there will be millions, hundreds of thousands, millions, billions perhaps, of tokens and cryptocurrencies that nobody's ever heard of that serve a very narrow purpose. So you have to think about cryptocurrencies and tokens serving purposes that may seem ridiculous at the moment, but simply are forms of expression. And yes, countries will build their own cryptocurrencies regulated by a central authority. These are known as central bank digital currencies. Although, of course, the role of an independent central bank itself is a relatively novel concept. It's only existed for 100 years. Arguably, it hasn't really served very well in the purpose of maintaining political independence and managing inflation. In the vast majority of countries, in fact, the central bank is easily manipulated by politicians and, in any case, is not very effective at managing the inflation rate or any of the other targets that it has. So will central banks still exist? Will these types of management roles fall to governments directly instead of independent or quasi-independent bodies? Will the whole central banking edifice still exist? Much like the idea of British Airways and Air France still kind of exist today, but they're not really state-owned enterprises anymore. And they have far less influence and far less power and control. So yes, we will have centralized central bank digital currencies, government and national digital currencies alongside private currencies and corporate currencies. In fact, these are the 3 primary domains that are emerging, and we'll look at some of the questions that explore that in a bit more detail. The emergence of the 3 domains being money of governments, various forms of digital fiat or blockchain-based fiat, cryptocurrencies that are basically not cryptocurrencies, money of the people, private and decentralized forms of currency that emerge on the internet, such as Bitcoin, and then finally money of the corporations, with the preeminent example being the so far failed experiment and promise of Libra, Facebook's digital currency. All right. Kima asks, which of the security tokens do you think will be at the center of revolutionizing the current global financial system, which remains in the hands of some oligarchs? Kima, all and none of them. You see, the interesting thing about security tokens is that there's no reason to centralize around a single security token. Both their capabilities and the markets in which they operate are wide open. Other people can copy their capabilities. They can be built on a variety of platforms. They're mostly interchangeable, and the barriers to entry and exit are very, very, very low. So there will be security tokens and security token platforms that proliferate like weeds, and many of these avenues will be explored. So which security token will be at the center of revolutionizing the global financial system? There won't be a center. And I think that's the most interesting and revolutionary aspect of revolutionizing the global financial system, is that there won't be anything at the center. It will all be at the edges of the global financial system. And that is exactly the revolution that is required. And it won't be done by one security token. It will be done by an ecosystem of interoperable protocol-based tokens that people can easily exchange. Zero knowledge proofs. JP asks, hi Andreas, can you please expand a bit on range proofs as found in the zero knowledge proof cryptographic field with perhaps a suitable practical deployment example? To some extent, yes, I can expand on what a zero knowledge proof is and specifically what a range proof is. The bottom line is zero knowledge proofs are based on an area of mathematics that allows you to do calculations without knowing what the actual numbers are. And this at first seems impossible, but because of various cryptographic techniques, what you can do is you can do basic arithmetic operations on encrypted numbers and get encrypted results that you can verify without knowing what the decrypted numbers are. So you can add A and B and get C, even though A is an encrypted number, B is an encrypted number, and the result you get, C, is also an encrypted number, and you don't know what the actual numbers are, but you can prove something. You can prove an equality, or in the case of a range proof, you can prove a range. Let me give you an example of how this might be useful with a range proof. So a range proof is an arithmetic proof or mathematical proof that shows that a set of encrypted numbers are within a range. So let's say you have a number x, and what you can prove with a range proof is that x is between 0 and some other number. Now, you might think, how useful is that? Well, let's look at a very specific example. If you take a transaction, a cryptocurrency transaction, where the amounts of cryptocurrency that are being sent in that transaction, that are exchanging ownership in that transaction, are encrypted. So no one can see how much money is moving from one person to another because the value itself is encrypted. Everyone on the consensus network still needs to validate that no one is cheating. And the primary validation you need to make with the values in a transaction is that you are not creating money out of thin air, which effectively means that what you want to show is that the money going into the transaction is more than or equal to the money going out, the difference usually being fees. Meaning that if you're spending X amount on the inputs and that is going to Y amount on the outputs, Y cannot be greater than X, because if Y is greater than X, you basically created money out of nothing. So you violated the monetary policy and the consensus rules of that transaction. But because X and Y are encrypted, you can't really simply say, is Y greater than X? But what you can do with a zero knowledge proof is do Y minus X, so outputs minus inputs, and say that the result of that should be in a range between 0 and the maximum amount of coins that are defined in the protocol. So if you know that the difference Y minus X is greater than or equal to 0, you know that the transaction is valid in that it is spending no more than it's consuming, and therefore the double entry bookkeeping, the basic accounting of the transaction, assets minus liability, credit minus debt, is the same. And so that's what a range proof is. And a range proof is used. It's a form of a zero knowledge proof because you don't know what the values are. You have zero knowledge about that, but you are still able to prove something. And what you're able to prove with a range proof is that the transaction does not violate the rules of basic accounting by proving that the difference is greater than 0. All right, Peter asks about Libra. Libra, the proposed Facebook digital currency. What is the status? What are the main issues? How will it be used? Will it be limited to certain countries? How will it be regulated, if at all? Some great questions, Peter. I actually did a talk about this when the paper for Libra was published. Just about the same week that the paper for Libra was published, I did a talk called Libre, not Libra. Libre means free, as in freedom, not Libra, where I talked about some of the challenges this currency would have. And my prediction was that as much fun and as interesting as the paper was, that paper had absolutely zero chance of seeing the light of day as a product operated actually by Facebook and its consortium of participant companies in any regulated environment in the world anytime soon without some very, very deep and significant changes. Meaning that the paper was full of idealism. It promoted an idea of a decentralized, open, and neutral system that was not under the direct control of Facebook, that didn't horrifically violate your privacy and build surveillance, and that would be easily accessible and acceptable in many countries around the world, thereby fulfilling the goal of banking the unbanked. And I predicted at the time that the chance of that actually seeing the light of day was zero. And the reason it's zero is because Facebook is a company that can be sued. And its owners can be dragged in front of Congress and told that they do not get to play central bank in the jurisdiction where they're trying to play central bank. And in some countries, Facebook may have enough power to bully politicians, and in other countries, the politicians at least have the ability to bully Facebook back, at least on the surface. And more importantly, Facebook requires interaction with the regulated banking system, and the regulated banking system partners of Facebook can be subject to enormous pressure. The bottom line is that a system built by a centralized corporation and running by a semi-decentralized but not really decentralized consortium of companies is a permissioned system. In order to exist, it has to acquire permission to operate in every regulated jurisdiction. That's 194 countries, principalities, and states, and several jurisdictions within them, like the several states of the United States, for example, in federated systems. Every single jurisdiction must offer permission, and where permission is withheld, that currency cannot operate in that jurisdiction without getting into very serious trouble. So I've established a set of criteria in order to evaluate things like this, and I use the simple acronym RIPCORD. And let's ask, is Libra ripcord? Is it the thing that will save you when you jump out of the existing financial system and pull the ripcord to open your parachute? And the answer is splat. Because ripcord stands for revolutionary, immutable, public, collaborative, open, resistant, and decentralized. And Facebook's Libra is none of those things, and more importantly, cannot be any of those things because it would not be given permission to be any of those things. So Libra, the white paper, shows a vision of something that is in fact revolutionary, immutable, public, collaborative, open, resistant, and decentralized. And Libra, the reality, which is not happening, and likely to be delayed for much longer, is delayed precisely because it cannot be revolutionary, because it has to get permission. It cannot be immutable because it's subject to jurisdictions where transactions must be able to be frozen, suspended, reversed. It cannot be public because public participation in the validation would basically break some of the jurisdictional controls. It cannot be collaborative. It must be a federation of private closed companies that exert iron fist control over it. Otherwise, it would not be given permission. It most certainly cannot be open or neutral or borderless and operate across borders with anybody being able to participate because it is subject to all of the jurisdictions of the banking system. It cannot be resistant to censorship. In fact, censorship is the very first thing that falls because it must be censored under any or every jurisdiction, and therefore it cannot be decentralized. Control must be centralized, and that control will be exerted with a heavy hand. As a result, it cannot bank the unbanked. It can digitally bank the already banked, those who already have identity, presence on Facebook, financial means, and the permission of government to be banked, those who are documented and legal in the eyes of the local jurisdiction, well, they can now add, perhaps, in some jurisdictions where permission is granted, a digital currency owned by Facebook that will subject them to a complete loss of privacy, the destruction of their local democracies, and brutal surveillance by a corporation that has no morals. And in return, they're probably going to get some fun emojis that they can play with. So Libra in itself is really quite a terrifying idea, because corporations building money gives them a very dangerous path into a future where they can control their users in a way they couldn't before, and they can monetize that control in a way they couldn't before. It's a threat to democracy everywhere, but it's unlikely to be permitted unless in places where it's able to bribe the local politicians or subject itself to the whims of the local politicians. Most importantly, though, it's important to understand what Libra does not compete with. Libra does not compete with central bank digital currencies because they are subject to some democratic controls, and therefore their governance model is democratic, not corporocratic. Furthermore, Libra is not competing with open public cryptocurrencies, with the Ripcord style open blockchains and open cryptocurrencies, such as Bitcoin. And the reason it doesn't compete with those is because it cannot be open, neutral, revolutionary, immutable law. It can't be any of those things. And Bitcoin is those things. Bitcoin is revolutionary, immutable, public, collaborative, open, resistant, and decentralized. And one could argue that there are a handful of other cryptocurrencies that also share some or more, or perhaps even most of those properties. There is a future for currencies that exhibit those properties because those properties don't exist in the traditional financial system. Those properties are desirable to create a world in which more people are included, and those properties cannot be fulfilled by any centralized organization that is regulated in several jurisdictions. Therefore, Libra does not compete against cryptocurrencies. It does compete against bank currencies. And this is where it gets really interesting, because if you are JP Morgan Chase or PayPal, the problem with Libra is that they know how to build computer systems that are highly addictive, and they have 2 billion users all around the world already, and they can dominate this new space of digital currencies. So the competition between Facebook and JP Morgan Chase will likely result in Facebook owning this entire space of corporate currencies. And they also have much greater political reach too. So it is very, very dangerous and competitive against various corporate currencies issued by banks. And it is very, very disruptive for the traditional financial system because it competes on their turf within the space of regulated, controlled currencies that are permitted by the government. Facebook wins, which also means that if the primary target for your cryptocurrency is to get permission from banks, adoption from banks, the blessing of governments, and to operate in a semi-regulated space where you play nice with the regulators, you may differentiate against Bitcoin, but you do so by falling directly under the shadow of Libra or a future Libra-like currency by another massive corporation that will absolutely crush you. So if your plan is to make the banker's coin on an open blockchain and play nice with the regulators, the problem is that Facebook can execute on that plan much better and will ultimately crush you. All right, so let's see what's happening in the chat. And I'm going to just check and see if you have any follow-up questions. Yeah, someone noted today is Bitcoin Pizza instead of Bitcoin Clock. We've got a few little fun props here just to promote some memes. If you don't know, Bitcoin Pizza is not a flavor or a topping combination. This is a commemorative meme, an emoji that I use to commemorate Pizza Day, which is in memory of the day in May that in 2010, Laszlo Hanyek made the first public commercial purchase of a retail product, 2 Domino's pizzas, for 10,000 Bitcoin. And that is Pizza Day, which started kind of the commercial use and established a base price for Bitcoin in a retail environment. Andrew asks, does the IRS have a tax token? That's a great question. No, the IRS does not have a tax token. Well, they do have a tax token. The IRS's tax token is called the US dollar, or more accurately, the Federal Reserve Note, because it is issued by a private organization called the Federal Reserve, which is neither federal nor reserve, as the name might suggest. The US dollar or Federal Reserve Note is the token of the IRS. In fact, that is its primary function. That's what the term legal tender means, meaning that you can pay your public debts to the government using that, and that's the only token that they will accept. It is not digital. For the most part, it is a semi-digital token. 92% of US dollars exist in centralized databases held by banks, Federal Reserve banks, commercial institutions, etc. And about 8% exist as primary monetary supply in the form of linen pieces of green fabric, printed fabric, and coins. So that is the tax token. Now, interestingly enough, as Dimitris notes in the forums, the IRS is taking increasing interest in virtual currencies, primarily because they're worried that virtual currencies will lead to various forms of tax evasion. So they have sent out a whole bunch of scary letters to people saying, we know you have cryptocurrency, and they have 3 different letters, one of which is, we know you have cryptocurrency, remember you have to report it, which is the nice one. Then they have the medium one, which is, we know you have cryptocurrency and you haven't reported it correctly, or you haven't reported it completely, which is the medium nasty one. And then there's the nasty one, which is, we know you have cryptocurrency, you haven't reported it, and you will be subject to penalties and audits. I received the nice one. I received the nice one because I actually did report and pay tax on all of my cryptocurrency activities since the very beginning. And I received the nice one that said, we know you have cryptocurrency. I'm like, oh, wow, such detective work, really, congratulations, very good job. I know you got that from the database of customers of Coinbase that you sued to get accounts of anyone who has done significant transactions, but there might have been some other hints giving you an idea that I own cryptocurrency. No, I don't know. Maybe I've been on TV a few times saying that I own cryptocurrency. Wow. So the IRS is now adding a question. So last year, in I believe 2019, for the first time, they put a question on the American tax form that said, have you ever owned, traded, sold, bought, blah, 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 any form of virtual currency or tradable token? This year, in 2020, that question is being moved to the top of the form, and it's in bold and in a little gray box. Just in case you missed it the previous time. And of course, you have to, under penalty of perjury, check the box that says yes or no. And the reason they do that is to put you in a box where if you lie, of course, you are subject to penalties of perjury. And if you say yes, then they can keep that in their back pocket for a future audit. So that's funny. So the IRS is desperately trying to catch up with the times because, of course, it is terrifying when individuals who are not rich multinational corporations or rich multinational individuals can tax evade in exactly the same way that rich multinational individuals tax evade. Let me tell you something. I paid a lot more than $750 in taxes in 2017. Some people didn't. Now let's talk about Bitcoin storage space. Nikos asks, at the moment, the whole blockchain for Bitcoin is around 350 gigabyte to download and become a full node. Can this be sustainable in the long term? If blockchain keeps growing and growing, that will require a tremendous amount of space to become storage space to become a full node. How are we supposed to tackle this problem? It may be a foolish question, but it really confuses me. It's not a foolish question at all. In fact, it is the basis of probably one of the biggest and most long-standing debates in the entire space since the beginning of Bitcoin. As Dimitrios notes in the forums, of course, Satoshi Nakamoto mentioned this very early on in 2010 in postings in various forums about how Satoshi saw this problem playing out. Now, most people immediately think of storage space, 350 gigabytes of data. But in fact, hard drives are very subject to Moore's law, which means that on average, every 2 years, they get twice as big at half the cost, or sorry, twice as big at the same cost, or half the cost for the same storage. So that aspect, storage isn't really a problem. I remember my very first hard drive that I purchased, I believe it was in 1985 or 86, and I'm embarrassed to say many of you were not born then, but in 1985 or 86 I bought my first hard disk drive, which was about the size of a shoebox. It held a whopping 5 megabytes. It sounded like a jet engine taking off, and it cost over $3,000 in today's money. So now I can put something that has 100 or 500,000 times the same storage space in a SD card the size of my tiny fingernail, and it costs $20. The problem isn't storage, however. The problem with blockchains is really the transmission of that data over the internet, because bandwidth does not grow as fast as storage or compute. So the limitations of Moore's law express themselves in bandwidth. Because bandwidth requires the deployment of infrastructure to millions and millions of homes all the way out in various rural locations. And that infrastructure is expensive. And if fiber optics haven't reached that area, it's very difficult to upgrade the bandwidth. Copper wires and things like that simply do not scale as easily as Moore's law. So the problem isn't the 350 gigabytes you have to put on the hard drive. The problem is that the 350 gigabytes have to be downloaded. And then not only downloaded, but then other nodes will ask you for that data because they're trying to download it. So it has to be uploaded again and again and again and again and again and again. I have so far provided the Bitcoin blockchain thousands of times from my own nodes, and currently uploading approximately a terabyte a month Bitcoin blockchain data serving other nodes that are trying to bootstrap. That's quite expensive, and it's something that's worth doing to support the ecosystem, and not too many people can do that. So the bandwidth is the problem. And then you've got the ongoing bandwidth. Every time someone sends you a block, that block is 1 megabyte. Great, so you receive it once over the wire. Then your node has to send it to every other node that it's connected to, usually 8 other nodes. So you receive it once, and then you resend it out 7 or 8 times to somebody else. That means you've now transmitted that 1 megabyte 8, 9, 10 times. Then somebody who just started downloading the blockchain connects to you and wants a copy too. So you have to send it again and again and again and again and again. So 1 megabyte of block leads to 8, 10, or 20 or more megabytes of actual consumed bandwidth as your node continuously updates the rest of the network with that information. And that is not sustainable. That is a lot more difficult to scale. So this has led to a big debate about what should be the limitation. Bitcoin has chosen on purpose to maintain a strict upper limit on the size of the base block. It's grown slowly from about 1 megabyte, which was the limit placed in early 2011 by Satoshi Nakamoto, a 1 megabyte limit. And then since then, it's now grown through a system called segregated witness to approximately 1.7 to 2 megabytes per block once you count the segregated witness signatures. It can go up to 4 theoretically. It really hasn't gone that high. So that's a constraint that's been put, and that constraint has led to congestion on the blockchain and the rise of transaction fees. Other blockchains, such as various forks of Bitcoin that chose a different approach to scaling, such as Bitcoin Cash, have increased their block size significantly. And Bitcoin SV, Satoshi Vision, has increased its block size dramatically, taking a very different approach. Of course, what that means is that the bandwidth and storage requirements for those blockchains have exploded, and that limits how many people can operate full nodes and how expensive it is to operate full nodes, which reduces the decentralization of the system. These are different practical trade-offs. So what's more important, decentralization or cheap fees? Capacity constraints or centralization of resources? So these are big arguments, big debates. They happen in every blockchain. And here's an important thing to remember. If a blockchain tells you, we can do it all, we can have 0 fees and fast blocks and security and decentralization, that's not true. You can only do that when nobody is using your blockchain. And it might look good at first. If there's only very little transactional use, if there's only very few nodes, and nobody's really using your blockchain, you get to live the honeymoon period. Well, Bitcoin had its honeymoon period from 2009 until the end of 2013. Blocks were not full. Transaction fees were 0.0001 Bitcoin or free. And it was very easy to fit everybody who needed a transaction at near 0 fees and get the blocks churning every 10 minutes, no problem at all. Then it got popular. So if you see a blockchain today that says, hey, we can do 0 fees, it's perfectly fine, we're scaling very nicely, there is a trade-off there. And usually that trade-off is reduced decentralization, and that trade-off is only not noticeable because there isn't enough demand for the capacity of that blockchain to really show how challenging this problem is to solve. So if your not very popular blockchain is handling the demand level perfectly fine, that's often because it's not very popular. All right, let's quickly check in the forum, in the chat room, and see what's going on here, if there are any follow-up questions. All right. So the next question comes from Victoria. Victoria asks about the difference between Ketch 256 and SHA 256. Victoria says, I noticed that a lot of coins, including Ethereum, use Ketch 256, which is the early stage proposal version of SHA 3, but not the final standardized SHA 3 under the NIST standards. Ketch 256 is a hashing algorithm, and it's very similar to SHA 3, but not compatible and identical. And Ethereum uses Ketch 256 for a variety of reasons, including to fingerprint transactions and blocks, as well as for its mining function that operates on Ketch 256, or SHA 3 as many people call it. Victoria asks, which of these, or which version, is most secure? You know, there is some argument to be made that SHA 3 or Ketch 256 is slightly more secure. It is a more modern algorithm. It's about 15 years newer than SHA 256. It is a standardized algorithm. It's the same fingerprint size, which is 256 bits. It's a bit faster and more efficient in its calculation, it does have some nice security properties. But in practice, the security difference is minimal. So in practice, there is really no security benefit to using Ketch 256 instead of SHA 256. There is, however, a very important strategic advantage to using Ketch 256, specifically because it isn't SHA 256. And the reason is that SHA 256 has been implemented very broadly on Asics, application-specific integrated circuits, meaning there are mining machines dedicated in silicon to hashing SHA 256 so that they can do Bitcoin's proof-of-work mining. Now, if you're running an alternative blockchain, any other blockchain other than Bitcoin, using the same mining algorithm as Bitcoin that has been implemented in hardware is very, very dangerous. Ask someone who's in Bitcoin Cash or Bitcoin SV to explain to you why it's dangerous, but the bottom line is that for a fraction, maybe 4 or 5% of the hashing power that currently runs on Bitcoin, 4 or 5% of the miners in Bitcoin could simply switch for a day, a week, a month to any of the other 256 coins like Bitcoin Cash, Bitcoin SV, or any of the others, and instantly execute a successful 51% attack, obliterating the security guarantees of that system. And that's because you have a lot of this hashing power lying around, currently being used when Bitcoin is more profitable. But if the mining becomes more profitable in one of these other coins, they can very easily switch. So the choice of Ketch 256 was a strategic choice by Vitalik Buterin in order to ensure that Ethereum did not have ASIC-capable machines to mine it. And in fact, mining was restricted to GPU-only mining. There have been a number of attempts to implement ASICs for Ketch 256. It's not that the technology is difficult to do, it's that it takes a very big investment to implement an ASIC, and that ASIC is not really profitable unless you get some economy of scale for fabrication. And in order to do that, you have to have a long-term roadmap for how you're going to roll out these ASICs and how you're going to use them to mine. And in the meantime, Vitalik Buterin has deliberately engineered into the Ethereum blockchain a mechanism for forcing hard forks called the difficulty bomb to ensure that ASICs are not developed and to ensure that miners do not get the ability to run away with the consensus rules. And what that means is that there's always an implicit threat in the background, which is if you develop ASICs for SHA 3, we will switch the algorithm. And we will switch the algorithm so as to make your entire investment in Asics worthless. And that creates a very important strategic differentiation. That means, first of all, that Ethereum is moving to proof of stake in a very deliberate way. But also it means that you can't simply bleed off hashing power from Bitcoin Asics to attack Ethereum. They're not compatible. So that's the fundamental difference. It's a strategic security and perhaps even a political security decision and not an algorithm security decision. Victoria has an interesting follow-up. She says, it gives me an inspiration of how to achieve security, quantum proofing, and a clear specification at the same time. Have a set of possible hashing or proof of work algorithms, any one of which could be used to generate a valid hash. Victoria, that's a great idea. In fact, it's such a great idea that it was implemented for the first time in 2012, I believe. And there are a number of blockchain systems that use a variable hash algorithm for their proof of work mining, meaning that there is a random factor into which proof of work algorithm will be used for the next block based on the previous block, or where you can use a variety of proof of work algorithms and switch between them at your choice. Although most of the time you don't have a choice, you have to use whichever one is the correct one for the next block under the consensus rules, which doesn't allow an exploited hash algorithm to dominate the network. You have to keep switching them, which means you can't implement Asics. A number of systems have done that. They've done it in order to prevent the implementation of Asics. They've made their consensus algorithm variable. Many other blockchains have done the same thing for digital signatures, meaning that you can have a choice of different digital signature algorithms. For example, ECDSA, EC1559, 25519, I believe, which is the Apple curve, or other elliptic curves, and or Schnorr signatures. And so there are a number of different blockchains that have tried various variations of this idea. You know, it's always nice if you have like this great idea, and some people might find it disappointing to say, oh, I had this great idea, but then I discovered that somebody else had that idea also. But another way to look at it is, it was such a good idea that somebody else also tried to implement it and put significant resources into it, and that idea is currently being tested in an environment, which means it was a really good idea to start with. It may not have succeeded, but keep coming up with great ideas. You never know. It's very difficult to have an original invention in this space, in any space really. That's the nature of innovation. The next question comes from Maxime. Polkadot. Is Polkadot the most confusing system to this day? Can you please share your opinion on Polkadot? I have been through several explanatory videos of how it works. It is by far the most complicated design I have seen. I understand it like a platform to connect other blockchains. We have relay chains, parachains, bridges, parathreads, fishermen, miners, blacksmiths, and its own currency DOT. It supports all currencies with a platform token, other currencies and chains, and it has its own token. Does this huge Russian doll system not become extremely confusing? It does. Honestly, yes. I mean, Polkadot is very confusing. There's a lot of terminology to absorb. But keep in mind, Bitcoin was extremely confusing when it first came out, and it took quite a bit of work to try to explain it. I was having a conversation with Gav Wood the other day. The inventor of Polkadot is actually the co-author of Mastering Ethereum, and we wrote that book together, Gav Wood. So Polkadot may eventually need a Mastering Polkadot book. I don't know if it's a book for me to write or somebody else. And I'm not sure that's the direction I want to go in, but it's certainly interesting to read about for the time being. And it is a very confusing technology because what it's trying to do is unify a lot of different blockchains and create an environment where you can run blockchains as programs. So think about it this way. Bitcoin was a blockchain that did money. Ethereum was a blockchain where you could program what you did so that you could program different tokens and other forms of money within Ethereum. So it's more of a platform for various programs that operate similar to how Bitcoin operates money. Well, Polkadot is kind of a meta level. It is a platform for programming blockchains. So it is a platform where you can write a blockchain, this is a parachain, that synchronizes with the rest of the system. And you can specify that blockchain, its parameters, its consensus rules, programmatically. So it can have its own token, but effectively you can build blockchains themselves as small programs that run in the Polkadot platform. So it's a kind of meta level, a blockchain of blockchains. Do we need one of those? Is it too complicated to succeed? I don't know. A lot of people have already characterized Ethereum as a Rube Goldberg machine, a Russian nesting dolls, a complex endeavor that has no good purpose. I disagree with that assessment, but it's too early to tell if it has a good purpose or not. And it's even more too early to tell for Polkadot. So for the time being, reading and learning about this technology and seeing which areas of research and innovation it can reveal and give us an avenue for testing new ideas would be quite interesting. I'm noticing someone in the chat saying they want to invest in this. Please note, I have not spoken about investment. I don't speak about investment. And I also think it is very, very foolish to look at these things as investments. This is a very early stage technology. The price is completely disconnected from fundamentals, and it is very close to gambling to be playing with these domains. So instead of saying I will buy some, instead say I will run it. Run the software, run a wallet, get some test coins, run a node, run a validator node. Try to understand the consensus algorithm, try to maintain a node. That's what I did. That's how I approach these things. Learning about the technology first, an investment as a long second. Only invest as much as you're comfortable with the technology, if you invest at all, and you might only invest in skills and knowledge. All right. The last question for the day, and I'm going to close up with this one, comes from Okechukwu. I hope I pronounced your name correctly. Okechukwu asks, I want to run a Bitcoin full node and participate in mining. How can I get help regarding power requirements, ASIC machines, and other technicalities? It's actually a difficult topic. Learning about mining, because a lot of the mining infrastructure, industrial infrastructure, is primarily driven out of China. Also, a lot of the documentation, ASIC information, manuals, etc., is in Chinese. And so it's difficult if you want to find information in English. There are a number of good mining forums where you can learn about these things. There's also a lot of web calculators that can show you, in terms of efficiency and the current difficulty rate on the Bitcoin network, for example, whether you have a chance to do mining at your current electricity cost. Electricity cost. That is the primary variable that you need to understand. Whether you are interested in doing mining depends on how unprofitable it is in your particular area. I'm going to go out on a limb and I'm going to guess that it is unprofitable. And the only question then is how unprofitable. Very unprofitable, or just a bit unprofitable? I'm not saying it's going to be profitable, because in order for it to be profitable, you have to get electricity that is very, very cheap, or almost free. And even with that very, very cheap electricity or almost free electricity, you have to mine for a long time to pay for the cost of the ASIC equipment. And that's only if you have the very latest, most efficient ASIC equipment, which is quite expensive. So if you're planning to spend anywhere from $5,000 to $15,000 to get one or two ASIC miners, and then run them for a year at very cheap electricity, less than 3 cents per kilowatt on average, and run them reliably and mine, and expect that during that year you might be able to break even on the cost of the mining equipment, then you have to consider whether that's really a useful path for you. If your electricity is not that cheap, if you do not have access to the capital to buy the very latest ASIC, all of your profitability numbers get worse and worse and worse. However, there is another reason why you might want to do mining, which is not about profitability. If today you want to buy Bitcoin and you live in a place where you have cheap electricity, but it's very difficult to acquire Bitcoin, exchanges are not broadly available, or if they are available, Bitcoin trades at a significant premium, maybe 20%, 25% above market rates against your national currency, which effectively means your national currency is trading at a 25% discount against Bitcoin because of currency controls. If there are significant problems with surveillance, if you live in an authoritarian environment where your government is dangerous and where owning Bitcoin or having people know that you own Bitcoin in that political environment is dangerous, then mining does offer one interesting possibility. It allows you, through the purchase of hardware that you may be able to get into the country, it allows you a way to acquire Bitcoin anonymously and essentially to convert electricity at whatever the cost into Bitcoin in a way that is both anonymous and that Bitcoin is pristine. It's clean Bitcoin that has come directly from the Coinbase of a block, has not belonged to anyone before, and has none of your identifying information attached to it. So that gives you a great way to buy Bitcoin anonymously with no exchange fees, with no government surveillance, with no identification. You're buying it with electricity. Now, for that privilege of getting private clean Bitcoin anonymously, you may be willing to pay the price of unprofitability if it actually costs you 10% more in electricity than the amount of Bitcoin you're going to make. If it costs you 20% more, 30% more in electricity, but in an exchange it already costs you 25% more, and that would have all of the other problems of surveillance, then it might be worth doing. It might also be worth doing if you were going to use the electricity anyway. A good example is if you live in a Nordic country where you heat your home with electricity. You're going to spend the electricity. Many Nordic countries only allow you to heat your home with electricity because that electricity is sourced from renewable sources and it's an environmental concern. And maybe there you are going to use that electricity to run an electric heater. Well, an ASIC is an electric heater. It's a very loud electric heater, but it is about as efficient as an electric heater. It will produce a lot of heat per watt. And therefore, what you can do is use the electricity you were going to use anyway, heat your home, and earn a bit of Bitcoin on the side. That may be an investment worth making. So those are all considerations that go into Bitcoin mining. One of the things you might want to look at is a mining profitability calculator. You would normally enter the price of Bitcoin, the difficulty rate. It might take that from the network. The electricity cost in your area in dollars per kilowatt hour. And then finally, the efficiency of the mining equipment you want to use, which would be in terahashes per watt. So how many hashes it can do per watt of electricity it uses. Based on that information, the mining profitability calculator can tell you how much money you can make mining at the current difficulty and the current Bitcoin price, and whether that will be enough to pay for the mining equipment after you've paid for the electricity. It can also give you an idea of how efficient your mining equipment has to be in order for this to make sense. So that's all ways you can figure out the answer to the question you were asking. And that's a great point to finish. Thank you all so much for attending these sessions. It has been an absolute blast and my pleasure to teach these 4 or 5 sessions for the 14th iteration of the massive open online course, the MOOC, for the University of Nicosia's Master's Degree in Digital Currencies. I'm your teacher, Andreas Antonopoulos. I've loved answering your questions. I look forward to our next session, semester 15, which I believe starts in February. And I hope to see even more students enrolled for that one. As always, please continue to ask questions in the forum. I won't be teaching another session for this semester, but there are more teachers, and they can also answer questions from the previous sessions if some follow-up happens that is important to answer. So please continue to ask questions in the forum. Thank you so much all. Have a wonderful weekend, and I hope to see you all soon. Take care. Bye-bye.